debt is the most useful tool in increasing investor returns, right? If we think about a deal where 100% of the money we put in is cash versus a deal where we're only putting in 30% cash, the return that we see on that 30% cash is significantly higher than we would see on a deal where we're putting in 100% cash. And so leverage certainly makes sense in terms of maximizing your return. However, we need to be careful that we're not entering into debt relationships or a loan environment where we're putting the principal of investors at risk in the form of a potential default. And so, when you look at this current environment, again, with the coronavirus, I had a call this afternoon with a group that, was telling me that they can withstand across their portfolio a 25% drop in occupancy before their debt service coverage ratio drops below 1. And that's a crazy number. That's very, very high. The stark contrast to that is most groups that can maybe deal with a 5, 10, 15% drop off before they start running into an actual risk of, can I pay my debt? And what we know from history is that when groups are not able to pay their debt, that's when investors ultimately lose principal. As banks foreclose on properties, there are forced sales, there is accrued default interest. There are a number of ways that money gets sucked out of a deal and goes to the first lien debt holder. And so the way that we look at debt has to be, first with a risk mitigation perspective. And so we want to see lower rather than higher, loan to cost, loan to value. But it's got to be a range, because we also realize that more leverage generates a higher return. And that's why that debt service coverage ratio is a number that's particularly important, because we want to know we have enough cash coming off the property that we can ultimately pay our debt service. And then there's some room to dip down below before we run into an actual issue.